Let's take a look at some questions on debt, notes, and bonds payable. A company finances the purchase of equipment with a $500,000 5-year note payable. The note has an interest rate of 12% and a monthly payment of $11,122. After 2 payments have been made, what amount should the company report as the note payable balance in its December 31 balance sheet? I'm going to simplify this, and I'm not sure if you have been through the process of buying your own home before, but I'm sure you're at least a little bit familiar. Think of this like you bought a $500,000 house, you financed it through the bank. They gave you, in this case, a pretty high interest rate of 12%, and these are your monthly payments. So after 2 payments have been made, it wants to know how much do you still owe on this house after 2 months have passed. Well, you might be tempted to just say 500,000 minus 11,122 and do that for 2 months, and that actually would get you to 477,000 here, and that's not the right answer. And why is that? I'll give you a second to think about it. Well, if you're familiar with how the mortgage process goes, or just pay downs in general of any debt, like we have here in accounting, you'll know that that monthly payment consists of both debt, meaning the balance, and the interest payments. So you're only going to deduct the principal reduction from the 500 because that is going to reduce how much you owe. Let's take a look here. We start with 500,000. This is month 1 right here, and this is month 2. This will be your standard debt roll forward schedule that you might have seen at work or here in studies. You have your monthly payment, 11,000. That's devised of interest and principal reduction. And you'll notice as time goes on, the principal reduction, meaning the amount you pay each month that goes toward paying down your balance, increases, and the monthly amount that you pay in interest decreases. That's just how it works. And how you calculate this, remember, you got to do 1 divided by 12 because this is a monthly amount. So 1 divided by 12 times, in this case it's also 12, but 12%, that'll give you the monthly interest rate. So it's really just 1%, right? Because 1 divided by 12 is going to be 12%. So then, where are we here? So we calculated the interest in the beginning of 5,000. Principal balance is now 493,000 because you're still only paying the total of 11,000. So principal reduction is basically the amount remaining after you've paid the interest. I'll just run through the math here quickly and show you what the heck I'm talking about. So for the first month, we had, where'd my text box go? All right. So for the first month, we do 500,000 times 12% times 1 divided by 12. I'm going to let you do that quick. All right. Well, that's how you would get to your $5,000 interest amount. And then from there, to calculate the amount in that month that you were going to reduce your principal, you do 11,122 minus 500, minus 5,000, and that's how you get to your amount of principal that you're paying down, 6,122. And you'll do that again for the second month. That's how you get your final ending balance of $487,695. On January 2nd, Vol Company issued bonds with a face value of $480,000 at a discount to yield 10%. The bonds pay interest semi-annually. On June 30th, Vol paid bond interest of $14,400. After Vol recorded amortization of the bond discount of $3,600, the bond had a carrying amount of $363,600. What amount did Vol receive upon issuing the bonds? This question is different from your standard lease questions or bond questions. I kind of loop those together because they have a similar process of amortizing. We're issued at a discount, and this is asking the amount you received when you issued the bonds. And the journal entries for bond issuance are critical. Definitely need to know those. And for those, you're going to debit cash because, right, like you receive cash. Why do you issue bonds? You do it to receive cash. You're always going to credit bonds payable because that's your liability, that's your offsetting account, that's what you're going to have to pay. And you're either going to debit or credit discount or premium. So in this case, it's a debit to discount because it straight up just tells us. And if it told us it was a premium, you would credit the premium. So at issuance, this is the journal entry you should get. The numbers, however, let's figure out how we get those numbers, because what we want, this is our answer. This is our answer. Like, forget the number for a second. What did you receive when you issued the bond? Well, you received cash. And how much cash? So this part of the journal entry is what we want. And how did we get there? Well, it gives us the carrying amount of $363,600. Okay, so that is after one period of amortizing the bond discount. And the amortization of the bond discount is $3,600. The short way to do this is it's after one period, so you just take $363,600 minus $3,600, and that basically backtracks you to the original cash amount. So here, bonds, I might have said monthly, but the bonds pay interest semi-annually. So, okay, beginning of the year, now we're semi-annual. This is the journal entry that was recorded, and this is also just what's given us, right? Bond interest of $14,400. We have discount on the bonds, that's the amortized amount, and cash is what's paid back on our principal. So this is our standard journal entry also for when we pay interest. So yeah, just by backtracking and saying our carrying amount, which is the amount that it currently is valued at whenever it is, whether that's next month, next year, subtracting out the amount that was discounted, gets us to our total of $360,000. So this question was giving you, because normally you go the other way. Normally you start at the beginning and you have to amortize for each period. But this question wanted you to take one period's worth of amortization and interest and backtrack it to find the base amount received in cash at the beginning. Hope you guys enjoyed these questions. I know I did. And stay strong throughout your studies.